live?
We are live. Happy New Year.
Definitely Happy New Year to everyone.
We are going to give people a chance to join, but we have not gone live since last year.
It's been a while.
So let's reintroduce ourselves.
Okay. My name is Rodney Williams, the CEO of Brown Investors Wealth Management.
I am Kim Williams, Rodney's wife, and also the CEO and also one of the co-founders for Brown Investors. So it's been a fun journey since we started in 2020, launching our membership, and then Rodney obviously spearheads the portfolio management side. And we are going to probably let him lead a lot of the conversation, because if you guys have seen me on the stories, you know that Brown Investors Education, we focus on the courses as well as we're sometimes a little knee-deep in individual companies because we like to invest in individual companies. And so Rodney's going to talk about the overall economy. And I know our daughter, Ariana Brown, one of the founders, too, is getting married this year. So
True. This is definitely very, very exciting. April is the month, so there will be a lot going on in the month of April. Month of financial literacy and also marriage. So hopefully we'll be able to avoid the rain. And hopefully by saying that, I'm not wishing any or foreseeing any bad luck. But this is one of the things that we're definitely going to do more of this year, because a lot of people had questions what's going on with the market. 2022 was a crazy year in the market. It's crazy when you think about it. 2020, COVID hit, stock market plummeted, and then quickly, basically like a V shape, trended down, popped right back up. 2021 saw a lot of that same acceleration. 2022, we saw it start to slow, primarily because of several factors. China and their strict COVID guidelines. But
I just want to interject really quickly, because if you don't follow the Brown Investors Wealth Management page, please do. But also, anything you hear today, Brown Investors nor Brown Investors Wealth Management is not your fiduciary. If you would like a financial advisor, and we are required to say this, please head over to Brown Investors Wealth Management, and you can work with Rodney or anyone from his staff. With that said, the purpose of today is for educational purposes only. We are not here advising you, nor does anything we say suggest that you should go invest in it. Got it?
True.
Got it.
And like I said, this can be like a lot of joint information. We're really honing some things forward. Going back in 2022, we mentioned how the China lockdown really shook the market in conjunction with the Ukraine invasion by Russia, in addition to the Fed coming and saying, okay, now we see inflation is not transitory. We need to really drill down and attack inflation. And they started hiking up interest rates, which the market knew was coming. However, the Fed imposed it a lot faster than what they had been telling everyone, and therefore it shook the market. And people were, instead of being proactive, they were reactive.
And so I'm going to raise my hand sometimes, because I don't want to interrupt Rodney, but Rodney, can I ask you, what is transitory? So one of my challenges as an investor is that I feel that Wall Street uses really fancy terms that is not necessarily common to the average person. And while I have now come up to speed with all of these terms, I think that it's important that we keep it simple. Keep it simple, stupid. So what does transitory mean?
So let me break it down this way, because I think just taking a step back and really explaining what was happening. Okay, when COVID occurred and the market plummeted, the government said, okay, we're going to basically kill interest rates. I'm gonna say that for lack of better terminology, just to help the economy survive. And then when you have no inflation, no interest, and what happens, of course, everybody's investing. It's a great time. People are borrowing money, because you're borrowing money at no cost.
So fast money, right?
Fast money. They pumped a lot of money into the economy. Many people were getting checks. It was great times for many people. However, as an old saying goes, at some point in time, the hens have to come to roost. So now they came back and said, okay, all this money we printed, all the how long we decided to allow interest rates to hover at the zero level, now that has negatively impacted the economy. We also had supply chain delays, but all of these factors, many of these factors we've never really seen before.
Yeah, and so that's a key point. So if you're taking notes or you want to become a better investor in terms of as it relates to economic waves, first key point Rodney just made is regarding the zero interest rates, the printing of money, the disbursement of checks, which means that in Wall Street terms, that is risk on. So risk on basically means that you are going all in with equities that have dropped to the bottom because you know the printing of the dollars gives you time to ride that equity, which, i.e. a stock, can go to the top. So if you guys remember Hertz going bankrupt and investors invested, they went with Hertz from, less than $30, and Hertz, which has now been restructured, Hertz during that time went all the way up to $300-400. So that could have been 100x return on investment for someone. I didn't personally invest in Hertz, nor I don't think did Rodney, but we had a lot of other fast, quick money wins. But that is the first key point that Rodney made, that when interest rates are near zero, you got fast money.
I think I'll make a lot of key points, but I think that's the first one. But going along with that, so you think about it, there were numerous companies that IPO'd back then. There are many companies that were around, but they started borrowing a lot of money. Yeah, you think about Zoom, think about Airbnb, you think about companies that were on the lower end, companies such as Peloton took off. Some of these companies you had that were more so, their growth was escalated tremendously by COVID. Amazon's always been a great company, but so many people were at home, they were ordering stuff off Amazon Prime, people were scared to go out. Now, move forward to 2022. What do we see? We see, okay, now these companies, now your profit is going to be somewhat diminished because now inflation is kicking in. Now interest rates are kicking in. Now you have another line item that's going on your books that's having increased. So what we see now, a lot of companies that were IPO'd, a lot of those companies, they didn't look as good when you actually looked at their books. Their books weren't built to combat what was forthcoming with the Fed hiking up interest rates. Go ahead.
So key point number 2 that Rodney just made is regarding the books of a company. So Brown Investors, we are typically, at least the education side, knee deep in individual companies. And one of the key things that you as an investor should recognize is that if you go through another period where the Fed is just lowering interest rates, printing out a lot of money, that is risk on. But there comes a time, like in 2021, where all of the new companies like IPOs, such as Zoom or Pinterest or DocuSign, all those companies, investors within Wall Street did risk off, meaning they cashed in, took their profits, and if you look at any of those companies, you'll see that they went from $300-400, at least Zoom did. DocuSign, I think, was around $200, and they came all the way down. And so to Rodney's point about the books, now Wall Street is basically truing up everything, where Zoom has a lot of liquidity. Zoom is one of what I consider one of the strongest IPOs out there, in that their income statements and balance sheets are super strong. Zoom is one of the leaders coming forth in the technology world, not just with video capabilities, but with so many other abilities within this new virtual world and digital world that we continue to live in. So point 1 was risk on when the Fed is lowering interest rates, or interest rates are close to zero and you're printing off a lot of money. Point 2 is risk off when you see that the Fed is actually starting to raise interest rates. And before I give the mic back to Rodney, one of the things I noticed, and one of the mistakes that I personally made, because I actually had to sit in the negative with a few of the IPOs that I like, was that before the Federal Reserve even made any implementations to the increase in interest rates, it was actually the notion or the suggestion that they were going to raise interest rates that caused all the big investors to pull their money out of the market and or pull away from growth stocks. So that was a big lesson learned for me, in that if the Fed suggests in the future that they're going to raise interest rates, if I'm in what's considered a growth stock, I, as a personal investor, will take my money off the table and I will wait until things shake out to get back into more of the growth stocks, and then maybe put my money into something that is more of an inflationary hedge. So,
okay, man, that's good. But one thing for certain is good companies are good companies. Apple, great company. Microsoft, great company. Amazon, great company. So you see that many of these great companies, their share price diminished by, or was increased by 20%. Tesla over 6% last year. But these are still good companies. Now the question is, when you look at their stock price, how much their shares were selling for, was it a great price at that particular time? But you have to understand how you're investing. Are you a short-term investor? Are you trying to day trade? Or are you a long-term investor? And I say that because if you look at it right now, one of the things that you can see is that you've been able to catch these companies, the great companies. I'm not talking about the middle of the pack companies. I'm talking about the top 5 companies in their categories, whether it be travel, healthcare, whether it's tech. If you can catch these top companies at basically bargain prices over the next several years, that's how you become wealthy. So it's understanding, listening to earnings calls, and I say earnings call because this is earnings season. So interesting thing about the market right now is last week the market was going pretty good. It was shaky up until Netflix had their earnings. Netflix had a good earnings call, showing subscriber growth. Also, they mentioned this is going to be the last time that they conveyed to everybody how their subscribers were increasing. That's the key, because the market is at a point where it's looking for momentum. What we've seen the last couple of months, we've seen CPI decrease, which shows that what the Fed is doing, which I think is very aggressive, but what they're doing is having a positive effect on inflation, which means that it is reducing. However, one of the keys that the Fed talks about quite often is they want to see unemployment increase, which you'll see in a lot of headlines, all of these companies mentioning layoffs. So
Amazon, Microsoft, Google. I think Amazon laid off 10,000 people.
Right.
Salesforce.com, 10,000 plus. Microsoft said they're laying off 10,000.
Right, and a lot of times with the top companies, when you notice when they announce these layoffs, their share price increases somewhat. It might be 2%, might be 3%, some have even popped 10%. But it's
and why is that?
Well, that's what because again, that's what the market wants to see. That's what the Fed wants to see, and also, and coming just from a common sense perspective, the market views that okay, if you're cutting employees, if you're laying off, fire employees, then okay, that's more profit that's being held within the company. That's more profit. That's more money that can be allocated toward different potential income generating revenues. So,
and we teach that in the Investing 101 course too. We try to keep it basic, but for someone who doesn't have a finance background, it may not necessarily be common sense that if you're cutting salaries, then you're going to get this plus more money on your income statements, which Wall Street considers to be more valuable, which means that now we can raise your share price. So to keep it stupid simple, KISS, if you were investing in, let's just say Apple, and Apple's share price is $100, and Apple goes and lays off half of their employee base, if you're an investor, you may want to put your $100 in or your $1,000 in so you can get some shares, and you'll likely see that Apple's share price within 6 months to a year will go from probably $100 to $200 because they're now a lot more profitable, which means that their share price is more profitable, and they're more profitable to the rest of the investors because they're not kicking out salaries, which is an expense to the books.
Yeah, and I'll say this for long-term investors. Again, 2022 was a up and down year. There will be some volatility, some fluctuation in 2023, but you definitely have to look at it from a long-term perspective. That while everything, just not being so reactive, which how many people are being very, very reactive right now. The market is at a place where it really wants to take off. It wants to soar because people want to make money. However, they're looking for that catalyst. So every little bit of good news, you see that the market is reacting in some form or fashion. In the reverse case, bad news, the market reacts. So what's been the catalyst for the most of 2022 and pretty much 2023 so far is what is the Fed going to do with these interest rate hikes? What are they going to do? Right now, we're looking at where the expectation is that it'll be another 25 point basis hike. It was 75.
And what does 25 basis hike mean?
It's easy if I had a chart, but I'm gonna do that on the next one. Just go down and do a clear breakdown of all the basis points because I think that'll be very good now that Kimberly brought it up. But I think that can really shed some light on what's going on. It's not as bad as everybody thinks, but these hikes again, it called the market. They knew what's forthcoming, but it happened a lot faster. And with these hikes continuing on, what goes on is the market does not like uncertainty, and that's the biggest thing. The Fed continues with all the good news that the market perceives as being good. Like I say, CPI going down, CPI steadily increasing, the market loves it, takes off. When they see unemployment increase, the market takes off. Unemployment comes in lower than the expectation. There's always these expectations that all these pencil pushers are saying, this is the expectation. CPI is going to be at this number. Oh, if it comes in below, great. Comes in above, oh, that's a signal. The Fed might go back and retract from the expectation of a 25% base hike, and let's go 50 or 75. So all these things, uncertainty is what makes the market nervous. However, one key thing is that the Fed has not really tipped its hand. It stays on the hawkish side. My hawkish side, it stays on the side of negativity, where for us as investors, and I say negativity from the standpoint of the Fed continually lets you know that we're not going to stop until inflation is addressed. So what that tells you is that the Fed, they don't care what's going on in the market. Right now, they have one goal: combating inflation, combat at all costs. And that's what they continue to convey in so many. But the market, all investors, they're hopeful that the track record of CPI having reduced, having come down over the last several months, that will help the Fed or motivate the Fed to change course somewhat and not be so aggressive in their pursuits of addressing inflation, and will let it come down gradually, because you will continue to hear of soft landing spot as opposed to a hard or a crash landing, which would then put us in a true recession.
And I'm just going to interject and back up for a second, because part of the feedback that I've received from a lot of our members is that it's still confusing. And so Rodney's on the institutional side. I work on the retail side, where it's individual investors. And when we talk about basis points, that's just interest rates. So if you hear the Fed, or if you see on Yahoo Finance or anything, you see 75 basis points, that's basically 0.75 interest rate, right?
Yeah.
So if you hear 25 basis points, that's 0.25%. So if you were in the market to buy a house and you see the interest rates toggling back and forth, which was the situation with our daughter Ariana before they closed on their property, that the Fed, based on what the Fed was doing, determined kind of like the interest rates that they were getting on their property. The other piece is CPI, so Consumer Price Index. The best way that I can explain it is when 2020 hit, if you were a long-term investor and you were invested in the energy sector, you made bank. And here's why. The Consumer Price Index showed that fuel and oil was at nearly 200% CPI, if you looked at the core Consumer Price Index, which doesn't include gasoline and oil. And if you were invested in like an ExxonMobil, or we had invested in a company called WPX, which we recommended to our members too, which was acquired by a company called Devon Energy. But this particular company went from $7 or $8 to nearly $100 over a 9-month period. And so as an investor, you always have to ask yourself why. And in anything that you do, you should be asking why. But if you take it back to the CPI, you will see why. The why that a company like WPX or even ExxonMobil or any other energy company for that matter went to a 10x return in less than a year was because the inflation, which is measured by CPI, was through the roof. And so if you're looking to get ahead of inflationary sectors and invest in sectors before they actually take off, you can actually go to a website called bls.gov, and that is where you find the consumer price index. And we actually have posted that on our pages before, but Rodney lives in this institutional world, so he's just rolling off with all the terminology. And we do give a cheat sheet too for the terms in the membership, but there are many ways to invest, and understanding why it's happening is just as important as the money that you are making.
True. But like I said, when it comes down to one of the main things is anything you invest in, really do your best to learn and know as much about that particular company. This is a great time to find out. I always tell people when you invest in something, first place, go to the investor relations page on the company, whom you're invested with, who you purchase shares with, who you're an owner of, to go to the investor relations page on the website and find out as much as information as possible. Listen to a path to the most recent earnings call. And right now, with this being earnings season, it's a good idea to go to that investor relations page, pinpoint when they're having their next earnings call, and try to go into and try to listen to it. Whether you listen to it, whether you just read the transcript after the earnings call occurs, it's always some good insight in regards to whether or not you choose to stay with that particular company. That's always a plus. Like I said, the market is looking for catalysts. Earnings season is typically a catalyst for the market. Typically gives a shift of how the market may or might not be moving. So the market's always looking on. The prediction of light has been for this earnings season has been a contraction in regards to earnings. So the market, you'll see that there's several hundreds and hundreds of companies that are having earnings calls weekly. But you always notice the big names get the majority of the headlines. And it's so funny when you might see a headline, and I'm gonna say this because Tesla hasn't had theirs yet, but you'll see, you might see Tesla prices surge after having a great earnings call. That surge might be 3%. So, but that have put in the that headline surge was enough to make you read that article. But just to give you an idea, Netflix had theirs. The market was happy with it, and now the big movers for this week, of course, Abbott. They're having their earnings this week. Wednesday, you will see Tesla, but also on that same day before, Microsoft has theirs. Tesla's been getting a lot of pub today. However, people are overlooking Microsoft, and that's going to be a very, very interesting earnings call. Also, closing out the week is Chevron. Chevron, when you think about energy, they're pretty much the primary one that's kicking off the earnings for the energy sector. So at least the biggest name. So that's going to be very, very interesting in regards to what they come up with their numbers, and I expect for their numbers to be tremendous with the price carried over from last year with how high energy prices are. But Tesla, even if you're not invested in Tesla, it's bound to be a very interesting earnings call, which I think pretty much anything that Elon Musk is involved in nowadays has become very interesting. So it's definitely going to be one that we're going to look to. But of course, Microsoft, that's one that we'll definitely be listening to, because you want to listen to those top 5 companies in the industry, at least the top 3, because they tend to give you an indication of not always, but a lot of times they can give you a little hint of how the market might be moving. And right now we're in a reactive environment. So when I say how the market's moving, if a Microsoft bombs on their earnings, it will likely have some type of implications on the market, because even though it might not directly affect some segments, what it does is it starts to create fear. And when you insert fear into the market, you see a lot of selling. When you have selling, you tend to see share prices decrease. Not saying it's something directly impacting that company, but we're in a reactionary period because everybody's trying to figure it out, and they're looking at any hints that they can obtain in regards to what the Fed might be doing.
All right, and so just 5 more minutes of your time because we are going to wrap this up. We will be going live more just to give you a perspective on what we're thinking. But one of the points that Rodney made in terms of fear, that's actually the time when we typically place a lot of buys because you should be greedy when others are fearful. And a great example that I could give you guys is Voyager Therapeutics. We recommended them to our members back in fourth quarter of 2021, and over a 12-month period, Voyager Therapeutics has now gone up 300%. And it's a matter of trusting the numbers, trusting the research, trusting the fundamentals. We do have members who are relentless on scheduling one-on-one consultations. And as long as the numbers within a company do not change, you should have the confidence to continue buying the dip. And unfortunately, sometimes we as investors get so caught up in the day-to-day or maybe like the week-to-week that we fail to see the bigger picture of the trend. And so for Voyager Therapeutics, great example of a company that's grown in revenue more than 2,000%. They just got approval for some new treatment. I won't go into detail because we do have members who are actively investing in our recommendations, but don't get so caught up in the news. Stay focused if you are an individual company investor, and if you like the big players, like the Microsofts and the Apples and the Teslas, you can also, stay the course and buy as much as you can. I'm personally not a big fan of the investing in the big companies because unless I've got money like Warren Buffett, I'm personally, not for anybody else, not even for my husband because we have different investing styles, I'm personally looking for the highest multipliers. But as we wrap it up, since you're talking about just the overall economy, and we will have to bring on our crypto expert.
But let me say this real quick. But also, right now we're talking about individual companies, but there are also another great avenue of investing is to invest in ETFs. But then, of course, ETFs, you have several companies listed on that particular ticker, which that's also a safer way in many occasions because you have a variety of...
XLE was a huge win.
Right.
Yeah.
So let's say an XLE, which is an ETF for energy, let's say, which right now in XLE you have Chevron, have Exxon. So let's say if for some reason Chevron, purely an example, I doubt, because what I'm about to say, I doubt this happens. But let's say if Chevron bombed on their earnings, and they decrease, okay, you still have these other energy companies that will be there to help lift that stock price up somewhat. So that's just a plus, like I said. But another way is sometimes you can just look at the top companies percentage-wise in that ETF. You might choose to invest in them. So it's different ways to go about investing. It all depends upon what your style is, what your risk tolerance is, and what's your timeline. People have different timelines, different risk tolerances. All those things come into play, as well they should, in regards to an individual's particular investing style. So there's different ways to get to the finish line, but always the goal is to get to the finish line to where you can retire comfortably and in a successful manner, so you can do whatever you want to do in your retired life, so you're not having to where money is not an overwhelmingly huge concern. That's always the ultimate goal.
Well, hopefully I can pull you from your desk tomorrow because we're going to table the conversation for Bitcoin and inflation.
Bitcoin is very, very interesting. Bitcoin.
My crypto account is finally coming back up after dollar cost averaging for over 28 months. So we can talk about that later. And if you guys have any questions,
Bitcoin is interesting. Cryptocurrency is interesting.
Please send them to admin@browninvestors.com. Visit our website, browninvestors.com, or drop some comments below. We want to make sure this is helpful and or cater our conversations, which will be very casual this year. We just want to make sure we get you the information. We want to make sure that you don't do anything rash, like sell an investment just because it drops, because that's the time when you should continue buying, and you'll look up and see how much farther you've come when it comes to delivering a much higher return on investment.
Yeah, it's definitely a time of patience, and just the companies you do your research, the companies that you're invested in. You've done your research, you know they're good companies. So just let them move. They will move, because what you'll see happen sometimes if unless the story changes.
Unless you're Party City.
Unless the story changes. So the story changes means sometimes you might have to pivot. But if the story still changes, then everything typically will be well. But if the story changes, you have to be prepared. You have to be prepared to pivot. I mean, you look at companies such as Kim mentioned.
Yeah, we can talk about that later this week too. We've got tons of stuff to talk to you guys about. We just want to make sure you get the information. But yeah, definitely email Avin@browninvestors.com if you have a specific question topic that you want to discuss, or drop it in the comments below, and we will certainly cater the conversation to what you need and what you have questions about. So happy freaking Monday, and cheers to a very, very prosperous 2023.
I agree. Hey, it's been great, everybody.
Peace.